action. So now let's talk about bearish divergence. It's just the opposite. What that means is price action is rising, it's in an uptrend, and the indicator is moving lower, is moving down from left to right. Again, it signals to us that the market could be at a top because price action is moving higher to grab orders. The indicator is moving lower, telling us that that strength, that RSI is actually moving down. Overall, the true move is going to be down. Another example, this is the dollar index. You can see over the course of 2 days, this is the 15-minute chart, you have your RSI high set here at the end of day, right? Moving into the next day, moving into today, what would be today, you see price action sets a new high. So price action is moving up, making higher highs, but the RSI is moving down, making lower highs. That's divergence. So what do? We can't trade it long, even though all the indicators tell us to go long. We can't trade it long until we're above the trend line on price action and on the RSI. What happens? It literally comes right to the trend line. This trend line is drawn using this reaction point and this reaction point. Price came right to the divergence line. RSI did not make a new high. And what does it do? Falls away from you. So you see the divergence is really trusting the indicator. It's really relying on the direction of the RSI and really the whole TDI. That's why I recommend using a TDI, because it gives you that market sentiment too that shows you how that starts to fall over. But again, you would not be long in here before the fall. You would not be long in here because you know you can't be long until it gets above divergence here and here. And it never does that. So use the divergence to keep you from getting trapped going long earlier in this day, because you know something is brewing. Strength wasn't building, strength was falling.